Alright, people. Let's continue our discussion with our next important topic, people. The one topic which is going to fetch you your 15 marks for your exam. You're looking at your total income chapter, most important chapter called as PGBP. Most important chapter called as PGBP. To understand this PGBP chapter, people, you have some adjustments to be kept in mind. But before you start the chapter itself, people, I've already clarified to you some things to be kept in mind before you start the chapter is that always ensure that first you are able to identify whether the income is under PGBP or under other heads. Some rules to follow when it comes to PGBP, people, that any business related operations will fall under PGBP. Any activities which are incidental to the business will not fall under PGBP but will fall under other sources unless it's mandated by a law. We discussed the case law, people. Case law number 1 which we discussed, we spoke about the fact that when you're going to have any kind of deposit money made with the bank, any kind of deposit money which is made by the bank for obtaining a bank guarantee, whatever interest is coming from that bank account will now not be called as incidental money because it was done with the sole intention to run a business, and therefore this interest will be taxable under the head PGBP. Yes, so rule number 1, any kind of interest coming from a bank deposit done as per a part of a law, or as a mandate of an RFP will be taxable under the head PGBP. Amendment number 2 of the current year, people, to be very careful in mind that going forward, if you are going to have any kind of house property, income coming from residential house property is now taxable under HP. It's not taxable under PGBP unless and until it's a commercial property. Yes, amendment of current year as per your act. 2 things to be kept in mind. Third thing, people, any kind of fertilizer bond which is given by Government of India in lieu of government subsidies would be treated as subsidy, and hence loss will be allowed as PGBP and not capital gains, because subsidy is given to you. Any loss coming from the subsidy is also PGBP loss and not a capital gains loss. Yes, couple of things other than that which you need to keep in mind, people, is that when a salary is received by a partner from a partnership firm, it is taxable under PGBP. It is not taxable under salaries, it is taxable under PGBP. Any subsidy which is received by the government, from the government by a person, will be taxable under PGBP unless it is a capital subsidy, in which case it gets reduced from the cost of the asset. When it comes to business, people, business gets split into 2. One is called speculative business and non-speculative business. Speculative business are those business which are done with no actual delivery. Any speculative losses you make from business will be set off only against speculative incomes for a maximum period of 4 assessment years, provided income tax return is filed on time. Yes, some things to be kept in mind, people. Items which are not considered as speculative transaction from an exam perspective, please focus on point number D. Where it comes and says if you have any commodity derivatives, it will not be considered as speculative transaction if commodity transaction tax is levied. However, if it is an agricultural commodity, then it is always non-speculative even if no CTT is paid. This has been tested in exam some time back, so please pay attention to it. Yes, when it comes to PGBP, people, format is very simple. You start from profit before tax. 4 adjustments to be made: disallowance, addition, allowances, reductions. Disallowance are basically those items which are claimed in accounts, not allowed in tax. Addition is basically those items which are not present in accounts to be taxed in income tax. Allowance is basically those items which are not there in accounts to be allowed in tax. Reduction are those items which are there in accounts to be removed from tax. Reduction basically means all incomes which are not pertaining to PGBP to be reduced from your net profit. We are starting with allowances. Income tax comes and says certain allowances are allowed under Income Tax Act. First item is rent and repairs. Income tax said all rent and repairs which you pay for buildings or plant and machinery allowed as deduction unless and until they are capital repairs, which in case will get capitalized and claimed depreciation upon. When you have such expenses and it is shared between personal and business, you will disallow personal expenses proportionately. Important section from exam perspective, we're looking at section number 32, which talks about depreciation. Section of depreciation comes and clarifies when you have depreciation, you can claim depreciation only when there is an asset which is owned by you and is first put to use and is first put to use. You can't claim depreciation on land and goodwill. You can't claim depreciation on land and goodwill. Depreciation rules are as follows. When you want to claim depreciation, asset should be put to use for more than 180 days in order to claim full depreciation. If the asset is put to use for less than 180 days, you claim only half depreciation. If the asset is not put to use, you can't claim any depreciation. If the asset is not put to use in the current year, but put to use for less than 180 days in the next year, you will claim full depreciation. You will claim full depreciation. Please be mindful about the green block. Please be mindful about the green block. If you have an asset which is not put to use in the current year, but put to use for less than 180 days in the next year, still you will be eligible for full depreciation and not for half depreciation. How do you claim depreciation, people? Income tax is given some block of the assets. First asset is building. Building ka rate of depreciation 10%. Building ka rate of depreciation 10%. Furniture ka rate of depreciation 10%. Buildings and furnitures go hand in hand. Furniture gets 10%. Plant and machinery gets 15%. Vehicles get 15%. Computer gets 40%. Books get 40%. Airplanes get 40%. Ships get 20%. Then intangible assets get 25%. That is what the rules are. When it comes to depreciation, people, two methods of depreciation given to you. One is WDV method, one is SLM method. SLM method only for electrical industry. Plant and machinery, if it is to be depreciated, it can only be depreciated at WDV. For any other industry. From exam perspective, your electricity is not being tested, therefore we are focusing on WDV method. Before you start depreciation, people, one thing to be kept in mind: when it comes to computer peripherals like printers, UPS, scanners, servers, they have same as computers, which is 40%. Computer software also becomes 40%. EPABX and mobile phones are not computers, and therefore they get plant and machinery of 15%. How do you compute depreciation, people? When it comes to your WDV method, you will take your opening block, add more than 180, less than 180, not put to use, reduce sale value of the asset, arrive at the cost of the assets. On the assets which are opening plus more than 180 minus sale value, you will compute full depreciation. Assets which are less than 180, you will compute half depreciation. Assets which are not put to use will get no depreciation, but will get added to the block. Whatever depreciation you have actually allowed will be claimed as depreciation and will be reduced from the block in order to find out your closing WDV. If there is an asset on which part of the asset is used for business and part is used for personal, you will claim depreciation only to the extent of business, but that is the same amount which you will reduce from your block as well. Do not reduce the whole depreciation, reduce only the business depreciation from the block. How do you compute cost of the asset, people? Cost of the asset means all the cost which you have incurred until the asset is first put to use, which means all your purchase price, all your ITC which is not creditable, all your borrowing cost until asset is put to use, minus all your government subsidy if it is related to the asset, minus all your scrap income, minus all your byproduct ka sale value, minus ignoring all your asset which you have paid by other than account pay check, account pay draft, electronic clearing system, other permissible modes more than 10,000 per person per day. Some special scenarios given to you, people. When you're having an asset which is used for scientific research, the asset would have been claimed full deduction and therefore cost of the asset is 0. If an asset is converted from capital asset into stock in trade, FMV will be taken as the cost of acquisition. Where the asset is acquired by gift or inheritance, take the cost of previous owner. If it is done with an intention to reduce tax, then the officer will decide what is the final answer. If an asset is bought in business as a building, then you will compute notional depreciation for the period you held it for personal reasons, and remaining asset alone will be brought in as cost of acquisition. If you are a non-resident which is operating outside India and is starting business in India, all assets bought from outside India will be again notionally depreciated and will be brought here. Any other asset, people, which you are bringing into business, you will bring it at original cost, not taking any depreciations. Original cost, not taking any depreciation. That is what it says, people. When you talk about here, it only means building. It does not mean any other asset. Any other asset can be brought at actual costs. Yes, that is what the cost of asset means. Sale value will be the actual sale value which you are reducing, people. Do not end up reducing any full value of consideration, any notional incomes and all those things. Actual money which you get in your hand is what you are going to reduce from the block. Dosing WDV depreciate panamode, you are only depreciating depreciation actually allowed. Don't remove any other personal depreciations of the computation. It is mandatory to claim depreciation. You cannot avoid the same. You cannot avoid the same. When it comes to depreciation, in the case of lease, people, depreciation will be claimed by lessor. Will be claimed by the lessor. Lessee cannot claim the depreciation even if it is a finance lease. Even if it is a finance lease, it is claimed by the owner. Depreciation can be claimed by the actual owner. It need not be registered in your name. It need not be registered in your name. Even if the asset is bought in the name of partner, firm can claim depreciation if the payment is done by firm. ICDS limited case law. ICDS limited case law. When it comes to hire purchase, the person who is purchasing the asset can claim depreciation from day one. From day one, whatever he pays back will be only called as installment payments. Yes, then you have a concept called as additional depreciation. Income tax says if you are manufacturing business, if you are a manufacturing business buying new plant and machinery, which does not include second hand plant and machinery, whether in India or outside India, office appliances, furnitures and all used in office premises, any motor vehicles other than forklift, and all the assets on which you have claimed 100% depreciation will not be eligible for additional depreciation. Other assets of plant and machinery will be eligible for additional depreciation at the rate of 20% in year 1. If the asset is put to use for more than, if the asset is put to use for less than 180 days, you will claim 10 in year 1 and 10 of original cost in year 2. 10 of original cost in year 2. Please note that if you are opting for any special regime of 115 BAA, BAB and BSc, you are not eligible for additional depreciations. Yes, after additional depreciation, people, if you are into amalgamation, demerger and everything, income tax comes and clarifies. In case of successions, you will compute depreciation for the whole year and then allocate this depreciation to both the predecessor and successor in the number of days the asset is put to use. Number of days the asset is put to use. Composite income we discussed along with your agricultural income. When you have a PGBP loss, people, when you have a PGBP loss, income tax clarifies to the extent the loss pertains to depreciation, the loss will be called, which will be carried forward for infinite years and will be set off against any head other than salaries. Any head other than salaries. Any losses other than unabsorbed depreciation will be called as business loss, which will be set off against business income. If you're not able to set off, you will set off against any head other than salaries. If you're not able to set off, you will for a period of and set off only against business income and set off only against business income. Next, people, you have something called tea, coffee, rubber development account. If this question comes, it will come along with agriculture income. Yes, this section basically comes and says that if you have a tea business, coffee business or rubber business, you can invest up to 40% of your PGBP income into a special development account. Into a special development account. If you invest that much money, whatever you invest will be allowed as deduction from your business income, will be allowed as deduction from your business income. Whatever amount you want to invest, you have to invest it within 6 months from the end of the financial year or due date of filing of return of income, whichever is earlier. Please pay attention to the fact that, people, if you want to give this deduction is given before computing 60/40, before computing 60/40, which means you will first compute PGBP. Let's say PGBP is 100. Let's say PGBP is 100. You will deposit money, let's say 40, which means taxable PGBP is 60. In this, you will then split into agri income and PGBP income. Agri income becoming 40% of this, which is 24, and then 36 for business. 36 for business. Yes, so please pay attention to the fact that, people, development account deduction given before composite split. Before composite split, whatever money you have invested, people, that money has to be used for only buying new plant and machinery. The money cannot be utilized for buying any plant and machinery for office premises, cannot be used for buying any office appliances except computers. Computers can be bought, cannot be used for plant and machinery on which you claim 100% deduction, cannot be bought for items which are prohibited goods items which are prohibited goods. If you are going from tea, coffee, rubber development people, you can also go to mining industry where you get something called site development fund. In site development fund, you can claim a deduction of 20% of the PGBP. If you are in the business of extraction of petroleum or natural gas, rules remain the same. All the rules remain the same. Whatever money you have, you have to utilize it within a period of 8 assessment years. 8 assessment years. Clear, not clear? Yes. People 33AB and 33ABA eligible for special regimes, not eligible for special regimes. These both are denied under special regimes, meaning no deduction granted under special regimes. After that, we are moving forward, people. We have scientific research. Only one rule for scientific research: 100% allowed as deduction except land. 100% allowed as deduction except land. However, if you are under default tax regime, you do not get deduction for donations. You get deductions for in-house. So in-house will be eligible for deduction, donations will be denied for default tax regime. That is the only thing to be kept in mind, people, which means point number A, eligible for both regimes. Point number B, eligible only for alternate tax regime. Point number B, eligible only for alternate tax regime. That is what the rule is. Yes or no? Yes or no? Yes, yes. When it comes to scientific research, people, the same rules apply. When it comes to scientific research, if there is any capital expenditure, which you are not able to claim as deduction, it will be called as unabsorbed capital research expenses, which will have the same rule as unabsorbed depreciation. Yes. Then if you are going to sell any capital asset, people, if you are going to sell the asset directly outside, whatever profit you make will be taxable under the head PGBP as balancing charge. If you are giving it to another business, cost of acquisition for the other business will be zero. In scientific research. Yes or no? Yes. Then we have something called as your 35CCC and 35CCD, which talks about agricultural extension project or skill development project. Any kind of agricultural extension or skill development project, you will be eligible for 100% deduction on any expenses except land and building, people. Here it is land and building, both are not eligible. Please pay attention. Scientific research building can be claimed. Agricultural extension and skill development building can't be claimed. These both items are not eligible under new regimes. Then we have something called as 35AD, which talks about specified businesses. Income tax says some businesses which income tax likes hospital with 100 beds, hotels with 2-star and above, any kind of warehousing facility for sugar, agricultural produce, not eligible for edible oils. Income tax comes and says any of these businesses, whatever capital expenditure you incur, you will get 100% deduction except for land, goodwill and financial instruments. All these things you have to ensure that the payments are made by permissible modes more than 10,000 per person per day. This is also not eligible under all the special regimes. These are also not eligible under special regimes. But please pay attention, people. When you say not eligible, it means that these businesses will now be called as normal businesses, which means you can claim normal depreciation. You will be denied 100% deduction, but you are still eligible for normal depreciations. That is what the rule is. Yes, if you have any asset under this specified businesses, people, you have to hold the asset for at least 8 years. If you are holding the asset for less than 8 years, notional depreciation will be reduced. Balance, whatever is there, will be taxable as income in the hands of specified business. The same notional income will be treated as cost of acquisition in the hands of the normal business. If you decide to directly sell it outside, whatever profit you make will be taxable as PGBP, called as balancing charge. But if you're selling it at more than the original cost, then it will be taxable under capital gains. The question then comes and clarifies, saying when an assessee has set up a hotel and applied for a 3-star category, deduction will not be denied for that same on the mere fact that the hotel was not given the recognition in the same year. Intention is to grant benefits, and therefore you have to have lenient provisions. You will be given the deduction right from day one. After 35AD, people, comes to your 35AB and 35ABB, which talks about your license fee and spectrum license fee. Income tax here simply comes and says whatever expenses you incur, you can amortize it over the life of the license. You can amortize it over the life of the license with only one rule, that you will only get the deduction from the date on which you actually pay the money, or commencement of business, whichever is later, This is 35 ABA and 35 ABB, very simple topics. Yes, then you have something called as your zero coupon bonds. Same logics, any kind of losses which you make from zero coupon bonds to be amortized over the life of the bonds in number of months. Where the month is having more than 6, consider full month. Where the month is having less than 6, you can where it is more than 15 days, you will take full month. If it is less than 15, you will don't take the month. Then you have preliminary expenses, people. Income tax comes and clarifies any expenses which you incur for preliminary expenses before you start a business or you start a company. Expenses can be claimed as deduction over next 5 years, subject to the rule that if you are having cost of the project, expenses cannot exceed 5% of the cost of the project. But if you are a company, it should not exceed 5% of the cost of the project or 5% of capital employed, whichever is higher. Where capital employed means shareholder funds plus long-term debts, does not include securities premium. Berger Payne's Supreme Court judgment to be kept in mind. Any kind of amalgamation and demerger expenses will be allowed over the next 5 years. Any kind of voluntary retirement scheme will be allowed over the next 5 years. Any kind of family planning expenses will be allowed over the next, provided they are capital and incurred only by, very good. If you are going to have 35, we have ignored this point, people. Summary is given to you of when expenses are amortized over the life and when expenses are allowed over 5 years. Then we have your standard on borrowing cost, where borrowing cost standard comes and says, when you have taken a loan, tell me, is it for revenue nature or capital assets? If you have taken it for revenue nature, interest allowed as deduction, subject to 43B, payment on or before due date of return filing. If you have taken the loan for capital asset, tell me whether the asset is put to use or not put to use. If the asset is put to use, interest will be allowed as deduction. If the asset is not put to use, interest will get capitalized. Thing to be kept in mind for the current year, expected question on this, we are looking at National Pension Scheme. Amendment of current year comes and clarifies, when an employer pays any National Pension Scheme contribution for the employees, he can contribute up to 14% of the employee's salary, where salary means basic plus DA forming part. Expect questions on this in exam, people. Yes, pay attention to this one. Then if you have any kind of employer's contribution to PF or employee's contribution to PF, the rules are as follows. If you are going to have employer's contribution to PF, you need to make the payment on or before due date of filing of return. If you make the payment on or before due date of filing of return, the expense gets allowed as deduction. If you make it after the due date of filing of return, expense will be allowed in the year in which payment is made. But if you are having employees contribution to funds, you need to make the payment before the statutory due date. If you make the payment before the statutory due date, allowed as deduction if it is taxed already. If not, then it is taxable permanently. No deductions on subsequent payments. Correct, not correct? Yes. Next, when you have bad debts, people, income tax says when it comes to bad debts, rules of accounts will follow. You need to follow 2 rules. Rule number 1, you should have offered the income. Rule number 2, you should have written off the debt. 2 rules satisfied, you will get the bad debts deduction. If bad debts was claimed in the past but assessing officer denied the request, in the current year when the bad debts recovery happens, you will not tax to the extent already taxed. Example we discuss, people. Imagine a case where you have bad debts of 5 lakhs. Assessing officer said he will only give 3 lakhs. In the current year, you have received 4 lakhs. You will go and inform, sir, I will tax only 2 lakhs in this because I already taxed 2 lakhs. 4 lakhs will be in your accounts. 2 lakhs is what you have to tax. Therefore, you will reduce 2 lakhs as a claim. Therefore, you will reduce 2 lakhs as a claim. Correct? Yes, that is what to be kept in mind. Then if you are into banking industry people, if you are into banking industry like Indian banks and cooperative banks, you will be eligible to claim something called provision for bad debts up to 8.5% of your GTI plus 10% of your rural advances, plus 10% of your rural advances. But if you are a foreign bank, PFI or an state financial corporation, then you can claim only 5% of your GTI, 5% of your GTI. When you have any bad debts people, you will not be able to claim the bad debts as a deduction before it is set off against provisions. So first knock off against provision. If you still have bad debts, that you can claim as deduction. Other deductions, as we discussed people, you have insurance premium, which is for any business expenses, any kind of bonus and commission paid to employees, any kind of deduction for animals which are unusable anymore, any kind of amounts which are transferred to special reserves by a bank or financial corporation, provided the amount does not exceed 20% of the profits. But at any appropriate stage, if the special reserve goes more than 2x of your share capital plus general reserves, then in that case I will not grant any more deductions. Then people, items like STT and CTT can be claimed as deduction under business, only when they are assets held as stock in trade, because if they were held as capital assets, it will be denied under capital gains. Finally, your ICDS standard comes and says any mark to market losses will be allowed as per ICDS standards. We discussed in mark to market people. What is the rules? Any kind of highly probable transaction or firm commitments will only be allowed in the year in which the transaction is settled. MTM losses of those are not permittable. Yes, any MTM losses can be claimed as deduction unless and until they are from firm commitment or highly probable transactions. Then we moved on forward people, where we spoke about revenue expenses. Income tax says you can claim all other expenses as a deduction subject to certain rules. Rule number 1, expenses should be incurred by you. Expenses should be incurred in your business. Expenses should be incurred wholly and exclusively for your business. Expenses should not be capital in nature and should not be payment for any offense of a law. Any of these conditions gets violated, you don't get the deduction. CSR expenses is disallowed. Donation made to political parties, not allowed. Any kind of gifts given to doctors, not allowed. Any kind of freebies given to doctors, any kind of bribe given to police, any kind of bribe given to gundas, not allowed. Any kind of heart surgery treated as capital asset, not allowed. Any kind of you have created a you have tried a project, new project, and the project did not work out, so the feasibility report, you conducted a market study, expenses incurred for that allowed. Pre-village roadshows will be allowed as deduction unless and until it's a new business, in which case McGrath will come and say it is not allowed. Unless and until McGrath says it is not allowed, that is what it is. Finally people, amendment of the current year, any expenses incurred to settle any proceedings are also not allowed. So any compounding fees not allowed. Any government contracts penalty allowed. People, government contracts penalty is allowed. Government ko pay another penalty, not allowed. Interest paid to MSME, not allowed. Interest paid under GST, allowed. Interest paid under income tax, not allowed. Penalty paid under GST, not allowed. Penalty paid under income tax, penalty paid to your customer, allowed as deduction. That is what the provisions are. Yes, then we discussed about interest and penalty. Interest, like income tax, disallowed. Other laws allowed. Penalty, both are not allowed. But when it comes to ICI people, ICI makes an assumption that the late filing fee which you pay for returns, section 234F will be disallowed. That has also been clarified by ICI here. Yes. Next, any kind of debentures, if you have buyback of capital or bonus issue which you make, whatever expenses you incur for that will be allowed, unless and until it's an expenses incurred for share capital increase. If it's an expense incurred for share capital increase, that expenses will be called capital in nature and therefore will get disallowed. So Any issue expenses incurred for increasing authorized share capital. Issue expenses incurred for authorized share capital will get disallowed. Expenditure incurred on glow signboards, people. I have a glow signboard, I've incurred expenditure for it. This is revenue expense, therefore allowed. Expenditure incurred for feasibility study conducting for examining proposals of a business subsequently abandoned will be a revenue expense. Priya Village Roadshow. Bear in mind that this has to be a existing business, not a new business. Then expenditure incurred on heart surgery of a lawyer will be treated as personal expense and therefore not allowed. Payments made to police and gundas to keep away from cinema theaters are offense payments, and therefore disallowed. Therefore offense payment and therefore disallowed. Yes. This is what your allowances look like. Any doubts? Good enough? Yes. Your disallowances, people, start from section 40I and 40IA, the important section from exam perspective and always tested in exam. We are looking at TDS defaults. Section comes and clarifies that if you have an expense on which TDS is deductible, please deduct before 31st March and make the TDS deposit before due date of return filing. If both the conditions are satisfied, expense will be allowed on accrual basis. If not, the expense will get disallowed to the extent of 30% in case payment is made to resident and 100% in case payment is made to non-resident. This expense will be allowed as deduction in the year in which TDS is deposited to the government or the payee offers the income, pays the tax, files a return, gets a CA certificate, in which case you can allow it as deduction. That is what the rule is. Section comes and clarifies that when you talk about TDS, it happens on accruals also, it happens on payment also. So paid word includes payables. When a payment is made to a non-resident and the transaction is not chargeable to tax in India, then you don't do TDS. Next comes your tax interest under Income Tax Act. They come and clarify any taxes which you pay under income tax, any interest which you pay under income tax, any surcharge, any cess, any late filing fee of income tax returns which you pay under income tax will be disallowed. Please bear in mind two things. One, this is only for income tax, not for other laws. So interest under other laws is allowed as deduction. Next, late filing fee is only disallowed for income tax returns, not for TDS returns. If you have a late filing fee for TDS returns, you can allow it as deduction. Next, people, if you have any foreign tax credit, if you are claiming that foreign tax credit, then it is not allowed as deduction. But if you have not been able to claim the foreign tax credit, you can report it as a loss. And you can claim it as deduction. So foreign tax credit can be claimed to the extent it is not claimable. Then comes your section 40A5, which tells that if you have any non-monetary perquisites for an employee, if you bear the expenses as an employer, then the tax on non-monetary perquisites will be disallowed. Next section to be kept from exam perspective, people, we are looking at section 40A2. This section 40A2 comes and clarifies when you have a payment made to a related party. The payment should not exceed market value. Where the payment exceeds market value, it will be disallowed. Rules to follow. Rule number 1, it should be specified person. Rule number 2, it should be an expense, not an income. Rule number 3, it should be excessive, not lower. 3 rules to follow. Rule number 4, payment is only disallowed if it is revenue expense, not if it is capital expense. If it is capital expense, I will not disallow that. Here, relatives means all the left side of the family, which means my siblings, my lineal ascendants, any entity in which I have substantial interest of more than 20% of profit sharing or voting power, any other entity in which my entity has substantial interest also, to be checked. Next section to be focused from exam perspective, section 40A3, which talks about payments made in cash or non-permissible modes, where you make a payment by account pay check, account pay draft, electronic clearing system, or debit card, credit card, BHIM, UPI, NEFT, RTGS, BHIM, Aadhaar Pay, and all those things. These are all permitted payments. Any other payments should not be made more than 10,000 per person per day. 10,000 per person per day. If such payment is made more than 10,000 per person per day, the expense will get only if it is there in the P&L. Only if it is there in the P&L. If it's a capital expense, you will reduce it from the cost of the asset. You reduce it from the cost of the asset. If an expense is of current year, and current year you have allowed it on accrual basis, next year if you make the payment by non-permissible modes, next year I will treat it as income. Items have exceptions as follows. First, they are coming and saying if it's a transport operator, you can make up to 35,000 per person per day. You are not permitted to make payments by bearer check or cross check. If you are going to make payments to RBI, it is allowed. Payments happening by book entry, allowed. Payments happening by adjusting net balances, allowed. Payments made to farmers, allowed. Payments made to farmers, allowed. Payments made to middlemen for farmer produce, not allowed as deduction. Payment made to authorized dealers for money exchange, allowed. Payments made to your agent for buying further products, allowed. Payments made to a person who is being deputed to another place more than 15 days not having bank account, allowed, fully allowed. Payments made for retirals, allowed up to 50,000. Payments made on bank strike day, not allowed. Payments made on bank strike day, not allowed. You have to make payments on bank strike even by permissible modes. That is what the section comes and clarifies. Then you have provision for gratuity. Next thing which is tested in exam, where they come and clarify that if you have a gratuity fund, you will be eligible for your provision for gratuity provided the payment is made on or before due date of return filing. If the payment is not made before the due date of return filing, any provision for gratuity will get and will be allowed in the year in which actually paid off. Then you have your foreign exchange difference, people. Income tax comes and clarifies any asset which you have bought from outside India, on credit basis, whatever is the foreign exchange gain or loss on final settlement will be capitalized to the asset, cannot be claimed as deduction, This rules will also apply if you have taken a foreign asset and a foreign loan, Please bear in mind that if the loan is from India, asset is from foreign, this rules will not apply. If the asset is in India and loan is from foreign currency, this rule will not apply. Two conditions to satisfy: loan should also be from outside India, asset should also be from outside India. Other than that, any other foreign exchange gain or loss which you have can be fully allowed as deductions, except for mark to market on firm commitments and highly probable transactions. Yes. Then we have the next important section, people, your section number 43B. This section clarifies some payments to be happened on or before due date of return filing. Payments are leave encashment, bonus or commission, employer's contribution to funds, use of railway assets, interest on loan to banks or NBFCs. One more. Any kind of tax payments, and including cess and interest and all those things. These payments have to happen on or before the due date of return filing. If you are going to make a payment to MSME, correct? No, it is only MS. Any payments made to micro and small enterprise. Any payments made to micro and small enterprise should be paid on or before 45 days if there is a written contract, or 15 days if there is no written contract. If the contract itself mentions a day lower than 45 or 15, then you will take the lower date. You should make the payments by these dates. If the payment does not happen by these dates, the payment will get in the year of accrual. And will be allowed in the year in which actual payment is made. Please bear in mind that even if the payment is delayed in this year and paid in the same year, the payment will get allowed, because it was disallowed on the date of default and allowed in the same year. Therefore, net effect is zero. Please pay attention to the fact that this is only disallowed for micro and small enterprise, not disallowed for medium enterprise. Next, they have come and clarified when you are having any interest will be disallowed on non-payment. If you convert the interest into loan, you cannot claim the deduction unless loan is repaid off. That is what the section of PGBPs look like. Small administrative provisions for you to pay attention to, people. First administrative provision is that you should maintain books of accounts. You should maintain books of accounts depending on whether you are a professional or business. If you are in a professional, then you should have a gross receipts more than 1,50,000 in all the last 3 years. If the condition gets satisfied, books are to be maintained as per income tax, which includes cash book, sales book, all bills, all sales bills, and all your daily case register and inventory logbook in case you are in a medical professionals. If you are a professional not satisfying these limits, then you have to maintain books, but sufficient enough that assessing officer can satisfy himself. If you are into business, as an individual with the PGBP up to 2.5 lakhs and turnover up to 25 lakhs, or any other person with the PGBP up to 1.2 lakhs and a turnover up to 10 lakhs in any of the last 3 years, you have to maintain books of accounts as per what is enough to satisfy assessing officer. If you don't satisfy the condition, need not maintain books of accounts. Books have to be maintained for at least 6 years from the end of your assessment year. Failure to maintain books of accounts will give you a penalty of 25,000. Failure to maintain books of accounts will give you a penalty of 25,000. If you are maintaining books, people, you may also have a requirement to get them audited. If you are into business, audit happens if your turnover is more than 1 crore. But if you are found out to have cash receipts up to 5% and cash payments up to of your total receipts and total payments, you can have no audit up to 10 crores. If you are into profession, limit is 50 lakhs. Due date of tax audit 1 month before the due date of filing return, which will be 30th September or 31st October. Forms to be filled is doesn't matter. Penalty for tax audit report 0.5% of your turnover or 1,50,000, whichever is lower is the rule. If you are not maintaining books or not getting them audited, people, you can choose for something called presumptive taxation. Under business, people, presumptive taxation will be given to you if your turnover is up to 2 crores. But if you are found to have a turnover up to 5% in cash, then it is 3 crores. You will have a presumptive taxation at the rate of 6% on all your payments by permissible modes received before 31st July, and 8% if you are not receiving the revenue or receiving the revenue by non-permissible modes. The moment you choose presumptive taxation, it is so assumed that all your PGBP adjustments are taken care of. No adjustments and PGBP will be done. Your unabsorbed depreciation of the past year will lapse. Your current year depreciation is assumed to be taken care of. No further changes to be made. No disallowance will be made under 40AI, 43B, 40A and any other sections for that matter. Yes, that is what the rule is. If you are opting for presumptive taxation, due date of return filing is 31st July. Due date for advance tax payment last quarter alone is what the rule is when it comes to business. If you are going for profession, people, the limit is 50 lakhs and 75 lakhs if the receipt is up to 5% in other than permissible modes. You will have to offer at least 50% of your gross receipts. PGBP adjustments are taken care of. Due date of return filing becomes 31st July. Advance tax becomes last quarter. No other adjustments to be made. Yes, if you are going under presumptive taxation for transport operators having vehicles not more than 10 at any time during the previous year, I will split your vehicles into heavy good vehicles having a capacity more than 12 tons, and other vehicles. If you have a heavy good vehicle more than 12 tons, I will tax you 1,000 per ton per month per vehicle for every month I am holding the asset. Or part thereof. If I am having an asset which is not an heavy good vehicle, it is 7,500 per month per vehicle for every For every month I am owning. Put to use is not important. Due date of return filing 31st July. Due date of advance tax. All 4 quarters payments of PGBP are taken care of except for salary paid to partners and interest on capital. These 2 adjustments can be additionally granted under presumptive taxation. For all the 3 presumptive taxation, choosing presumptive means you don't have to maintain books, you don't have to get them audit. Choosing out of presumptive means you have to maintain books, get them audit. If you are under presumptive of business, you can't choose presumptive for the next 5 assessment years. This is what presumptive taxation looks like. Yes, when it comes to your construction contracts, people, ICDS rule comes and says, tell me what is the duration of the contract. If the duration of the contract is less than 90 days, revenue will be recognized based on completion of the project. If it is done after 90 days or it's going to take more than 90 days, then it will be done based on percentage completion method. If I am not able to determine any clear basis on how to recognize revenue, I will do it based on straight line method. If you are having an asset which is an NPA under a bank, interest on that NPA will be recognized only when the money is actually received. That is what the sections come and clarify in case of PGBP. Some special points which we discussed earlier also, people. When you are purchasing raw materials in cash exceeding 10,000 from a sabji mandi, you will have to decide whether payment is made to farmers or middlemen. If it is made to farmers, allowed. If it is made to middlemen, not allowed. If the machinery spares are included in closing stock, this will be added to your cost of the asset for the purpose of depreciation. But under PGBP, people, notice that it's part of closing stock. If it is part of closing stock, understanding would be that it's also part of opening stock or purchases, which means under my P&L I will make no adjustments, but in my cost of the asset I will increase it to claim more depreciation. Air conditioner, refrigerator is installed in the residence of the director. This is allowable as an depreciable asset because it is given for business reasons. What is the depreciation rate on office equipments? Same as plant and machinery, therefore 15%. Provision for gratuity is based on actual valuation. Allowed, not allowed? Not allowed unless paid before due date of return filing. GST is refunded to the company by the government. Will be treated as your income unless further transferred to your suppliers. If you supply it further, if you give it back as a refund to your suppliers, then it is not taxable as income. But if you keep it to yourself, then it is taxable as income. If you have industrial power tariff concession received from government, this is nothing but government grants, therefore fully taxable. Profit from hedging contracts entered for meeting out losses in foreign currency, risk of imported plant and machinery. People, imported plant and machinery means 43A will apply, therefore all profits and losses will be capitalized. Next question plainly states that depreciation is computed as per section 32 income tax or income tax rules. Any other adjustment will not be taken. It will be assumed that this asset number is final answers. Any one-time license fee paid for obtaining franchise debited to P&L. This is an asset cost to be depreciated at the rate of as an intangible asset. Then any kind of bonus paid to employees under dispute. To avoid late payments, company has created a trust and transferred the money to the trust but not paid to employees. This will not be allowed as deduction unless actually paid to employees. Bonus ka fund ella trust irukadra. Next, expenditure incurred on a project abandoned subsequently without creating an asset. Like I said, if it's an existing business, you allow as deduction, but if it's new business, you will disallow as capital expense. Expenses incurred for public issue of shares where shares could not materialize. This is capital expense. Therefore disallow. Any kind of loss from trading in derivatives, it's a normal non-speculative business, therefore allowed as deduction. Any kind of expenses incurred for which invoice is not available but I can furnish indirect evidences, allowed because indirect evidences are available. Finally, any kind of expenses incurred for ISO certification. will be a revenue expense because it is not having a asset creating capacity. It is not having an asset creating capacity. Yes, sir. Yes. Last topic, people. We have something called as ICDS. Rules of ICDS comes and says you have ICDS applicable only for PGBP and IFRS, provided you're following mercantile system of accounting. Provided you're following mercantile system of accounting. If you're following any other system of accounting, this will not apply. Cash system ka ICDS does not apply. Rules of ICDS, people. When it comes to ICDS number 1, I will take all rules same as accounts except for a concept called materiality and prudence. Except for a concept of materiality and prudence, ignore those two concepts. ICDS number 1 talks about accounting policies, which we have just now discussed. ICDS 2 talks about inventories, which says you have to recognize inventories at cost or NRV, whichever is lower. However, if the business is into liquidation, you will recognize asset only at NRV. You will recognize asset only at NRV, even if the cost is lower. Even if the cost is lower, this is a significant difference from your accounting standard. Please bear that in mind. Then, when it comes to ICDS number 3, like we discussed right now, when it comes to contracts, any contract less than 90 days, project completion more than 90 days, percentage completion, not definite SLM basis, any kind of escalation in price will be deemed to be an income in the previous year in which it is received, even though it is not certain. ICDS number 4 talks about revenue recognition, only deals with very limited scope of interest, royalty, dividends, does not talk about your casual incomes because it is already covered under special rules of 115B. When it comes to revenue recognition, same rules will apply as AS 9. Same rules will apply as AS 9 unless and until there is a difference in income tax, like interest on enhanced compensation, which is taxable only in the year in which amount is received. When it comes to tangible fixed assets, rules will apply same as AS 10 PP. Only difference is depreciation will be computed as per section 32. When an asset is exchanged, people, I have taken an asset and received an asset. The cost of the acquisition of the new asset will be FMV of the asset received. If that is not available, it is FMV of the asset given up. That is what the rules is. When it comes to foreign exchange, people, like we said, monetary items will be allowed on restatement basis itself. Non-monetary items will be only allowed on settlement basis, same as AS 11. When it comes to forward contracts which are entered for speculation, trading, hedging, foreign currency risk of firm commitment, or highly probable forecast transactions, these forward contracts or the loss will only be recognized in the year in which contract is settled. Any other MTM losses can be claimed on restatement basis, on an yearly basis. That is what the rules is. When it comes to government grants, people, the same rules will apply. If the grant is received for a capital asset, you will reduce from the cost. If it is received for a revenue item, it is taxed as income. If it is something in accounts, they say put it in capital reserve, you will still tax it as income in income tax. Government grants in income tax comes and clarifies, grant will be recognized in the year in which it is fairly certain that you will receive it. But if you have already received it, then you will recognize it as revenue, even if chances are that you may not satisfy the conditions. When you deny the conditions in the future date, you can reverse it, but you cannot delay it beyond actual receipt. When it comes to securities, people, income tax comes and clarifies, securities will be recognized based on fair value concept and actual cost model. The significant difference between your your accounting standard and ICDS is that when you compare actual cost or NRV, here you will compare it on category level, whereas accounting standard compares it on asset level. We have done some example, people. Yes, that is what the difference will be. A little bit of a difference will come in that. It has not been tested for a long time, but good enough for you to know. Finally comes your borrowing cost, people, where the standard of borrowing cost comes and says when an asset is a qualifying asset, any interest or other borrowing cost incurred will be capitalized until the asset is put to use. When the asset is not put to use, you can after put to use, then you can claim it as expenses subject to conditions of 43B. And lastly, your provisions, contingent liabilities and contingent assets. Income tax clarifies provisions in income tax can only be recognized based on based on section 36, based on section 36, meaning a provision, if it is unascertained, then it is not allowed as deduction. It should be a ascertained provision like gratuity, bonus and all those things which are subject to conditions of 43B. Yes, those are all provisions which are allowed as deduction. Provision for bad debts are not allowed as deduction because these are already covered under section 36. This is what your provision looks like. Two adjustments for you to keep in mind, people. Any provision created for periodical wage revision for employee based on reasonable certainty, allowed, not allowed? Allowed, because there is reasonable certainty. Next, contractee withheld portion of contract revenue which should be released after a specified period. People, I have money withheld. Does it mean that it will not be recognized as revenue? It will be still recognized as revenue. It will be still recognized as revenue unless you can prove that the contract is held for less than 90 days, in which case it becomes project completion method. In which case it becomes project completion method. Is this clear, everyone? Any doubts on PGBP? No? I want you to spend some time, people, and go back and read the PGBP once again. When we do compulsory questions, most of these things will come back to you once again. Yes, when we do compulsory questions, I'll again be clarifying to you what is important and what is not important. But pay attention to this once again and see how much you understand. Is this clear, people? Yes, yes, yes. Sweet. Thank you, people. Have a good weekend.